Kieran Sutherland, financial planner here. At any time, you should be thinking about how to de-risk your mortgage, but particularly at the moment as rates are coming off historic lows and have run from about 2% to 6% in about 12 months. The stargazers that try and predict what interest rates are doing often and usually get it wrong. This is because there are so many reasons why interest rates change, and not a lot of them are predictable. While it is important to try and think about where interest rates are headed and include this in your thinking about your overall strategy, I think it is much more important to think about your own situation and what is and isn't affordable for you. By using fixed rates, you can essentially pay a premium to the bank to lock in certainty. This certainty means that you know how much your payments are going to be. So with my first mortgage, I locked in for 5 years as I simply couldn't afford to take the risk that in 12 months, rates would be higher than what they were then. The home loan was taking up a significant portion of my overall income at that point. But unfortunately for me, the following year, the global financial crisis hit and rates started falling really rapidly. And so I ended up breaking my mortgage and locking in a cheaper rate. A better way for me at the time would have actually been splitting my mortgage up into portions to allow for the fact that rates could go up, but they can also go down. And that at that point in my life, it was likely my income was going to increase and I would have been able to pay a bit more as that happened. So how does splitting your home loan work? So instead of having, say, a $300,000 mortgage on a 2-year fixed rate, you have 3 $100,000 mortgages on a 1, 2 and 3 year rate or other fixed terms. This helps to lower risk because if rates have spiked up, you only get the increase on part of your home loan, not the full amount, lowering the amount of cash you've got heading out the door. You then have a full 12 months until the next one comes up for refix and can adjust your life in between times. And then if rates start to head down, you get some of the benefit of that as well at the time. And it might not be right to split into 3 equal amounts. You might value certainty more, so you might fix a larger amount on a longer fixed term and smaller amounts on shorter terms. So in terms of mortgage strategy, there is no perfect strategy, and hindsight is a wonderful thing. We're much better to focus on what we can control and what risk we're prepared to take. If you want to have a chat on any of this, feel free to get in touch.